Welcome back to the Neuro Finance Masterclass. So we've spent all this time building your financial ship, right? Making sure it's strong, making sure it's pointed in the right direction. But today, we need to go below deck. We're going to go down into the engine room because we are on the hunt for hidden dangers, these silent leaks that can sink even the mightiest vessel.
I want you to really think of your entire investment portfolio as that great ship. It's powerful, it's headed towards your destination, financial freedom, but it is not invincible. And you know, the biggest threats aren't always the giant storms you see coming on the horizon. Sometimes they're the slow, silent leaks, the ones you don't even realize are there until it's way too late.
So in the world of investing, these leaks actually have names: fees and taxes. They are so quiet, they are relentless, and they are, without a doubt, the silent assassins of compound interest. They're just draining your wealth one drop at a time, often without you ever even noticing.
So let's start with the first and honestly the most common leak out there. This is the one that Wall Street has absolutely perfected. We are talking about the tyranny of fees.
Okay, so here's the pitch, and you've got to admit, it's a very seductive one. Wall Street sells you these things called actively managed mutual funds. The whole promise is that their expert managers, their whiz kids, are going to use all their skills to beat the market for you. And for this amazing service, they just charge a tiny little management fee, maybe 1 or 2% a year.
And that sounds perfectly reasonable, doesn't it? I mean, I keep 99%, they take 1% for all their hard work. Our brain just immediately goes, yeah, that seems fair. But this intuitive math, it's a trap, and it is a fatal financial error.
Just look at what actually happens over time. That fee is not a one-time charge. No. It's deducted from your entire balance every single year. It doesn't just take 1% of your initial money, it takes 1% of your compound growth year after year. It's literally gutting your returns from the inside out.
So what is the real cost? What's the final bill? Well, after 30 years, that seemingly tiny 1% fee doesn't just cost you 1% of your wealth. It devours nearly a third of your potential gains. 28% of your future is just gone, vanished.
So the crucial point to get is this: that fee, it isn't an investment in your future, it's a direct wealth transfer. That money isn't building towards your financial independence. No, it's paying for the fund manager's brand new Ferrari.
Okay, that is the bad news, I know, but the good news is you are the captain of the ship and you absolutely can plug these leaks. So let's move to the defense and talk about how you keep what's yours.
This is exactly why we champion low-cost index funds. Think about it. An actively managed fund pays really expensive humans to try and outsmart the market. An index fund, on the other hand, well, it's run by a computer that simply tracks the market, like the S&P 500. There are no expensive managers to pay.
To see the real cost of any fund, you need to look for one specific thing. It's called the expense ratio. This number, it's always expressed as a percentage, is the true price tag of any fund. It tells you exactly how much of your money is getting siphoned off each year to cover the fund's operating expenses.
And the difference is just staggering. An actively managed fund, it might have an expense ratio of 1%, maybe 1.5%, or even higher. A good S&P 500 index fund, its expense ratio can be as low as 0.03%. That is practically free. You get to keep all the compounding power for yourself, and Wall Street gets pennies.
Okay, so with the fee leak plugged, we now have to check for the second one. This one's a little more subtle, but believe me, it is just as damaging if you ignore it. It's the tax trap.
Here's basically how it works. The tax system penalizes impatience. When you're constantly buying and selling, trying to time the market, any profits you make are taxed at a really high rate called short-term capital gains. But if you hold your investments for the long term, for years, the tax code actually rewards you. Your profits get taxed at a much lower long-term capital gains rate. And that is a huge difference that can save you thousands over time.
This is why our strategy of dollar-cost averaging and holding on forever isn't just a neurofitness strategy to keep you calm, it's also a really powerful tax strategy. If you remember one thing, remember this: patience is literally untaxed wealth. The simple act of doing nothing protects your growth.
All right, you now know where the leaks are and you know how to fix them. So it's time to take command of your ship. Here are your captain's orders. A simple, 3-step action plan you can do today.
First, I want you to log into every single one of your investment accounts. Second,
For every single fund or asset you own, find that critical number, the expense ratio. Third, be ruthless. If you are paying anything over 0.5% in fees for a fund, you are bleeding compound interest. Your mission is to find a low-cost alternative, like an index fund, and plug that leak for good.
And that brings us to the final, critical question you have to ask yourself as you go through your accounts. I want you to look at every single fee, every single charge, and ask, is your money working to build your freedom, or is it quietly leaking out to build someone else's Ferrari? The choice, and the power, is all yours.